Your paycheck was supposed to hit your account Tuesday morning. It didn't. Wednesday afternoon, still nothing. You call payroll. They say it was sent Monday night, same as always. You call your bank. They say it's processing, should be there soon. Thursday morning, it finally appears. No explanation, no apology, just late. This isn't about your paycheck being denied or your account being frozen. This is about time. Time that wasn't there before. Time that got quietly inserted into a system you thought was automatic. And if you felt that extra day of waiting, you felt something much bigger shifting underneath the surface. Here's what's happening. Payment systems across the country are adding delays that weren't there 6 months ago. Not failures, not crashes, just time. Extra hours, sometimes days, between when money gets sent and when it actually arrives. The technical term is ACH settlement delay, and this week it hit 48 hours for routine transactions that used to clear overnight. By the end of this video, you'll understand exactly where this delay comes from, why it's spreading through the system without anyone calling it a crisis, and what changes in your daily life before anyone admits there's a problem. You'll see how time becomes the first casualty when payment systems come under pressure, and why that matters more than most people realize. Most people think electronic payments work like email. You hit send, it travels instantly, it arrives. That's not wrong for small amounts between major banks during normal times. Venmo, Zelle, direct deposits, automatic bill payments, they feel instant because the delay is usually so short you don't notice it. When your employer sends your paycheck, it goes into something called the automated clearinghouse system. ACH processes about 30 billion transactions a year. Everything from your salary to your mortgage payment to that subscription you forgot to cancel. The system batches these transactions together and settles them in waves throughout the day. Under normal conditions, this happens fast enough that you experience it as immediate. Money leaves one account, appears in another, usually within hours. The delay exists, but it's invisible, like the time it takes light to travel from your lamp to your eyes. Technically there, but irrelevant to your experience. This is why when people started noticing delays a few weeks ago, the explanation sounded perfectly reasonable. Higher transaction volumes, weekend processing schedules, routine compliance checks, all true. All normal parts of how the system works. But this still doesn't explain why timing that worked fine for years suddenly started feeling tight. Here's what actually happens when you send money electronically. Think of it less like email and more like shipping cargo through a port. Your payment doesn't travel directly from your account to its destination. It gets bundled with thousands of other payments, loaded onto what's essentially a digital freight train, and sent to a clearing facility where it gets sorted and verified before being delivered to the final destination. The ACH system runs on what's called batch processing. Instead of handling each transaction individually, it collects payments throughout the day and processes them in groups. There are specific windows when these batches get sent out, usually several times during business hours, with longer gaps overnight and on weekends. During each batch cycle, every transaction gets checked against fraud databases, verified for sufficient funds, and matched against account information. This isn't just a technical process, it's a risk management process. Each step creates an opportunity for the system to catch problems before money moves to the wrong place. Most people never see this step. When everything works smoothly, your payment gets bundled into the next available batch, clears all the checks quickly, and arrives on schedule. The entire process feels automatic because it usually is. But here's what's different now. Those batch processing windows are getting longer. Not because the technology is slower, but because each verification step is taking more time. Hold on to this. It matters later. Think of payment settlement like blood circulation in your body. Under normal conditions, your heart pumps blood through your arteries. It delivers oxygen to your tissues and returns through your veins in a steady, predictable rhythm. You don't think about it because it just works. But when your cardiovascular system comes under stress, from exercise, illness, or injury, the first thing that changes isn't a complete shutdown. It's timing. Your heart might beat faster or slower. Blood might take longer to reach certain areas. The system still functions, but the rhythm changes. Payment systems work the same way. When banks sense any kind of pressure, higher transaction volumes, regulatory scrutiny, or uncertainty about counterparty risk, they don't stop processing payments. They add time buffers, extra verification steps, longer review periods, additional confirmation requirements. This part sounds small, but it isn't. Time buffers are how financial institutions manage risk when they can't control all the variables. If a bank isn't completely certain about the creditworthiness of another institution, it might hold on to funds for an extra few hours before releasing them. If transaction volumes spike unexpectedly, automated systems might slow down processing to prevent errors. Now here's where this gets more complex, and this is the part most people never see. The ACH system doesn't just connect your bank account to your employer's bank account. It connects thousands of financial institutions in a web of relationships where everyone owes money to everyone else at any given moment. Your paycheck might travel from your employer's account at Bank A, through a regional processing center, to a Federal Reserve facility, then to your bank's correspondent bank, and finally to your account. Each step in that chain represents a different institution taking temporary responsibility for your money. Under normal conditions, these institutions trust each other enough to move money quickly through the chain. But when trust gets even slightly strained, each institution starts holding onto funds a little longer before passing them to the next link. Not because anything is broken, but because taking extra time reduces their risk exposure. Stay with me. This connects in a way most people never see. Let me give you two real examples of how this plays out. Last Tuesday, a mid-sized manufacturing company in Ohio sent payroll for 200 employees at 6 p.m., same as they do every 2 weeks. Normally, those direct deposits hit employee accounts by Thursday morning. This time, they didn't arrive until Friday afternoon. The company called their bank. The bank said the payments were submitted correctly and were moving through normal processing channels. No errors, no flags, no problems, just slower than usual. When employees called their banks, they got similar responses. Everything was fine, just taking a bit longer to process. Here's the second example. A small business owner in Texas pays her suppliers through automated ACH transfers every month. Same amounts, same accounts, same timing for 3 years. This month, payments that usually clear in 24 hours took 72 hours. Her suppliers started calling, not panicked, just checking. She had to explain something she didn't fully understand herself. Neither of these situations made the news. Neither caused any major disruptions, but both represent the same underlying shift. Time is being inserted into routine transactions without explanation or acknowledgement. Here's the sequence of how payment delays spread through the system, and this is crucial to understand. It doesn't happen all at once, and it doesn't affect everyone equally. First, delays show up in business-to-business transactions. Companies paying suppliers, contractors paying subcontractors, businesses making loan payments. These transactions tend to be larger and involve more verification steps, so they're the first to experience longer processing times. Then, payroll systems start running tighter. Not failing, just operating with less margin for error. Companies that used to submit payroll on Tuesday for Thursday delivery start submitting on Monday to ensure Thursday delivery. The delay gets absorbed by changing business practices rather than affecting employees directly. Only after that do consumer transactions start showing noticeable delays. Direct deposits, automatic bill payments, person-to-person transfers. By the time individuals start experiencing delays, the system has already been adjusting for weeks or months. Here's the part people miss. Each level of delay creates pressure on the next level. When businesses can't rely on precise payment timing, they start holding more cash reserves. When payroll timing becomes unpredictable, companies adjust their cash flow management. When consumers notice delays, they start checking account balances more frequently and keeping larger buffer amounts in checking accounts. But this still isn't the final break. The last stage is the one nobody prepares for. The most important changes happen in human behavior, not in the technology. People adapt to unreliable timing long before they admit the system has a problem. Think about how you already behave differently around money than you did 5 years ago. You probably check your account balance more often. You might keep more cash in checking rather than moving it immediately to savings. You've maybe started paying bills a day or two earlier than you used to, just to be safe. These aren't responses to system failures. They're responses to system unpredictability. When you can't count on precise timing, you build in your own buffers. You create your own safety margins. This is happening at every level. Small businesses are keeping larger cash reserves. Individuals are maintaining higher checking account balances. Companies are adjusting payment schedules to account for longer processing times. None of this shows up in economic statistics. GDP doesn't measure how often people check their bank accounts. Employment numbers don't capture whether paychecks arrive on Tuesday or Thursday. Consumer confidence surveys don't ask about ACH settlement delays. But here's what does change, and this is where the real impact lives. When payment timing becomes unpredictable, people start making different decisions about spending, saving, and planning. A family that used to pay bills the day after payday now waits an extra day to make sure the deposit has actually cleared. A small business owner who used to operate with a $5,000 cash buffer now keeps $10,000 in checking, just in case payments take longer than expected. These adjustments feel prudent and responsible. They are prudent and responsible. But they also represent a subtle shift in how people relate to the financial system. Trust that used to be automatic becomes conditional. Timing that used to be assumed becomes something you have to verify. The psychological shift happens gradually. You don't wake up one day and decide the banking system is unreliable. You just start double-checking things you used to take for granted. You build in extra time for transactions you used to consider instant. You develop habits that protect you from delays you didn't used to experience. This brings us back to the question we started with. If your money wasn't denied, blocked, or frozen, why did it suddenly start arriving late? And what does that change before anyone calls it a problem? The answer isn't about system failure. It's about system stress. Payment delays are how financial institutions manage uncertainty when they can't eliminate risk entirely. Adding time creates space for additional verification, more careful review, and extra confirmation steps. From the system's perspective, this makes perfect sense. Better to deliver money safely with a delay than to move it quickly and create problems later. The delays represent the system working as designed under stress conditions, not the system breaking down. But from your perspective, the delays change everything about how you interact with money. Timing you used to count on becomes timing you have to plan around. Automatic processes become processes you need to monitor. Financial routines that used to be invisible become routines you have to actively manage. Understanding this pattern doesn't eliminate the delays, but it does change how you think about them. When your next paycheck takes an extra day to arrive, or when a payment you sent doesn't clear as quickly as expected, you'll recognize what's actually happening. The system isn't broken, it's adapting. And your experience of slightly longer delays, more frequent balance checking, and tighter cash flow management isn't a sign that you're doing something wrong. It's a sign that you're responding appropriately to changing conditions. The most important insight here isn't about payment systems or ACH settlement mechanics. It's about how large, complex systems communicate stress through small changes in everyday experiences. The delay in your paycheck isn't just about your paycheck. It's information about pressure somewhere else in the system that you're feeling before you can see it. So here's the question worth sitting with. What other small changes in timing, routine, or reliability have you started adapting to without really noticing? And what might those changes be telling you about larger shifts that haven't become obvious yet? The answer to that question might be more valuable than any explanation of how payment systems work.